Welcome to TMS Insights October 2020. It's been a really amazing year in markets. The last period has been full of a lot of good things, as well as Ben Clark and Jeremy Hook bring you the update of what's going on. And Ben, it's been a lot of macro stuff. I mean, we've talked through reporting season and clients are aware of our views of a lot of stocks. But I think in this session today, we want to talk through what are the big settings. And, one of the moves that we've seen, and will surprise people, how much the bond markets move collectively over the year and what that means for share markets overall.
Yeah, I mean, I think, when it ultimately comes down to it, what moves share markets are really only two things: interest rates and earnings. And all the other stuff is kind of noise, which creates short-term volatility, but the long-term impacts are generated by that. And what we've had this year as a result of COVID everywhere in the world, but is interest rates going to zero. The RBA are likely to cut again in November, and to start quant easing, which is a first for this country, which will involve them buying long-dated bonds, 10-year bonds, which will compress the yield that those bonds trade on, which is going to further, we think, accelerate this issue that many people will have if they've got too much cash. And not just people, it's industry super funds, sovereign wealth funds. Everyone has to report a return. And if you've got too much cash and you're getting 0.3, 0.4, it's incrementally, I think, going to support the equity markets.
And it's fair to say that we don't know what's going to happen next with things. But as Ben said, the things that we can focus on that we actually know are that rates are low and possibly falling, and how supportive that is for equity markets. And we now see that the market is approaching 8-9 month highs, so a post-COVID high, which is great, but it really shouldn't surprise given where rates are, Ben.
No.
And I'd made the comment, as I do to clients, against bonds and property, equities looks good value overall.
Definitely, particularly because the earnings of the market has largely held up, and in pockets of the market, the earnings have accelerated. And I think, you've got the obvious thing where low returns in cash, where else can I get a better return? And I think that this has still got, it's only in its initial stages of playing out. Firstly, because a lot of companies aren't paying dividends at the moment. So if you're sitting in cash, you're not seeing a solution in equities. And secondly, money that is tied up in cash at the moment might be in term deposits or in bonds, and it's not until they mature or roll off that people then look at what to do with that cash. So it'll be something I think is going to play out over the next few years, but I think it could be a really big driver of parts of our equity market.
And those low rates encourage governments to spend money, as they announced in the budget they would do, on infrastructure. But overall, that budget was very supportive to the economy and good for the market.
And the unique thing with this budget is how quickly the money is going to be spent. Normally, money is set aside, $1 billion is going to go here, but it's going to go there over 10 years. In this case, Morrison has said most of this money is going to hit in 2 years. So it's a lot of money pushing in. But I tell you, compared to what the Americans are talking about in stimulus, it looks tiny, because that is, Joe Biden is wanting a $3 trillion US stimulus package. Trump's at 1.8. Regardless of where it ends up, it's enormous.
And this factor jumping into the US, because when we looked at 2020 at the start of the year, not knowing what the factor of COVID might present, but knowing there was a US election was a factor for the markets to consider.
Definitely.
And we have been a bit worried about Biden, but he actually turns out with stimulus of that kind, he too could be good for markets potentially.
Yeah. Well, I think as the odds have shortened on Biden and as the money has come in for him, what's been interesting is the US equity market has rallied. So that sort of says the market is not overly concerned about a Biden win. I think there's only really two nasty scenarios that could come out of the US election. The first is if it's ultra close and Trump refuses to leave and it's a drawn out process of who's the president. And secondly, if the Democrats get control of the Senate. That would mean that they have the Senate, the House and the president.
And that never really works well, because too much can happen and markets like a little bit of check and balance.
Absolutely.
So, but going into that, we thought he'd be a high taxing kind of president potentially too. That still remains a chance. But once that money stimulates the economy, I think the net benefit will exist there. And there's no doubt that's okay. We come into a bit of bank reporting, a lot of AGMs at this time, Ben. So we're seeing updates from companies. I'm surprised how good a lot of them are.
Yeah, amazing.
And where companies are reporting lower sales, they're not down by a lot.
Yeah.
And so overall, the little snapshot on the market is quite supporting to your point about where earnings are headed.
Yep, and I'd agree. Like, I think there's more upgrades coming through than downgrades. Yeah. The analysts, I think, are still quite conservative in where their numbers are, so it's an easier thing to jump over for most companies. But I think the big thing is if you think just beyond, say, 2021, and in 2021 the market will be pricing in 2022, it's that companies have cut a lot of costs out of their businesses. Their cost bases are low, and when you hopefully get a vaccine and we start to go back to a bit more of normal life, things, lockdowns end, etc., you get the revenue kick up on much lower cost bases, and you could actually have a really good year of earnings growth.
That's right.
In tandem with ultra low interest rates, which is potentially a very big positive for the share market.
So putting this all together and getting some investment thoughts there, this concept of a yield drive, if you've got bond yields so low, the consequence is that consistent dividend paying stocks look a lot better value then, and could potentially rally quite strongly into next year. Yeah,
I mean, I think over the next few years we could see a bit of a yield boom, which we have seen in the past. The reason, as I was saying before, I don't think it's really kicked off yet is because a lot of companies have either cut or deferred their dividends. So it's not an obvious thing there. But, if you look at where do investors go out of cash when they're still feeling cautious and they're a bit worried about the market, it's normally into property or infrastructure. They're sort of seen as the next safest things, pay good dividends. But both these parts of the market have been hammered by COVID. Shopping centres, offices, commercial property have really copped it. And infrastructure stocks, some have been untouched, others have been hammered, airports, toll roads, etc. But it's worth looking at these before the recovery starts and before the income starts flowing again, because you want to get into them while the prices are still a bit out of favour.
And by the time the dividends are declared, the price will have adjusted up.
Exactly.
So we're talking about Atlas Arteria, Transurban, Sydney Airport, APA.
Spark Infrastructure,
good,
and Auckland Airport, which is starting to have a bit of a run. And I really think that the companies that needed to recapitalised, there's no reason theoretically that these companies couldn't trade on 3 to 4% yields, and that if the dividends return back to where they were in 19, and some will take longer than others to do that, share prices could move materially higher, as well as getting a good income stream coming through. So looks like a good area to me.
Definitely. So there's some good things to talk to your advisor about and have a look at on the market, looking at a potential rate cut on Melbourne Cup Day. Nice little winner for everybody, and a bit of QE towards the end of the year, which is really very significant and will help the market again. We'll be back in November with another update.